what you saw was the war starts, oil spikes, the Fed kind of not freaks out, but kind of hits the brakes a bit and says, well, wait a minute, this is going to mean inflation. But we know that the Fed can't control inflation on the cost of goods side because of energy spike, the cost of energy spiking. Like it has nothing to do with demand. It all has to do with, or even money supply. It just has to do with the pure cost of the main component of everything. And changing interest rates isn't going to do anything with that. It's not just that we can't print oil. It's that you've got this economy that appears it could be rolling over itself with the massive layoffs that we're seeing in the tech sectors. Now, of course, it's difficult to tell exactly what the numbers are because the BLS has the way that they create the data for the job numbers, and I say create because it's not like they just survey and tell you what the survey is. Well, as we both know, Joe, the market hates uncertainty. I mean, absolutely despises uncertainty. So, the last number of months have been, last month and a half have been pretty rough on the investment side to try to gauge what exactly is going on, and quite honestly, as an institutional investor, this has been one of the most difficult markets to invest in a while. Like, what is going on? Why is everything selling? Where's the safe haven? Well, there is no safe haven. The safe haven becomes your money market, and that's it. And that's the scary part. So in that event, Bitcoin won't be saved either. I mean, that'll draw down too. And I would expect that to draw down pretty steeply. What winds up happening is oil gets to a spot where it's so expensive and goods and services are so expensive that suddenly you have demand destruction instead of just pure inflation. I know you know this. I'm kind of walking through it for the benefit of the listeners. But so that kind of sets the frame of where we came into this week, where you had the Fed funds futures. They spiked. In other words, going into the Fed meeting a couple of weeks ago, the Fed funds rate was looking like it was going to come in by a full cut and some odd going into the end of the year.
Welcome back to Over the Horizon, a Bitcoin podcast. Today I'm here with the inimitable James Lavish. James, welcome back to the show.
Thank you for having me, Joe. Always good to talk to you.
Absolutely.
Big words
Absolutely.
Right out of the gate here.
That's right. Yeah, no, good title for you. Let's jump right into it. There's a lot of stuff going on. We've got Iran, lots of different developments there. First, I want to talk about what sort of impact you think this is going to have on markets over the next several weeks as this continues to unfold. We've got a ceasefire agreement. It doesn't seem like our side is really honoring it all that much. Tentatively yesterday, supposed to take place over 2 weeks. But it doesn't seem like that's actually going to hold up. We saw a very similar thing last year. So how are you reading the tape right now?
Yeah. Well, as we both know, Joe, the market hates uncertainty. I mean, absolutely despises uncertainty. So for the last number of months have been, last month and a half have been pretty rough on the investment side to try to gauge what exactly is going on. And quite honestly, as institutional investor, this has been one of the most difficult markets to invest in a while. It seems like the dynamics of what can happen out in Iran can change just from minute to minute with 140 characters, just with a tweet. His tweets are a little bit longer than 140 characters typically, but sometimes the all caps really jars the markets. So we've been watching for this, and look, if you go to first principles and you look at it objectively, you can't, just looking at who Trump is, what his personality is, what he really cares about, what he showed he cared about in his first term. And quite honestly, that squarely is on financial and financial markets, stock markets, and a little bit of crypto now with his family involved there, but he cares about the market. So that's one thing. The second thing is he really cares about his legacy. He's a huge ego, and he wants his legacy to be remembered fondly and as a powerful and successful leader. And so that means the midterms are important to him. You can't come up on midterms and get slaughtered by losing the House and the Senate, and just that would be in his mind, I believe, catastrophic. It's hard to get in his mind, but you understand what I'm saying. And so that means to me that he's looking for a resolution soon. This can't drag into the summer months as campaigns start really heating up for this fall election for the midterms. And so he's going to want a resolution, which I got a demonstration of this week. So the big words, the threats, I mean, the borderline insane threats of wiping a country off the planet is in all caps, is just like, it's difficult to stomach for people who are used to leaders in that office having a certain amount of dignity, and it's just a different delivery. Some people love it. Some people hate it. The markets don't typically love it because it just swings them around. They've become a little bit numb to it, as you've seen over the last number of weeks, is that they're like, does he really mean that? And then you've got this term taco that Trump always chickens out. He's a big talker and all that. But so the markets keep demonstrating that with every tweet, though, things move, and specifically oil moves. So which gets down to the crux of everything of this whole war economically. What really matters, if you take out not to belittle the deaths and the human toll of this war and any war, but this war in particular, the element that's square in focus is oil. Exactly. And what is crude doing? And crude has moved, as you can see here with your chart. Yeah, it doubled and then came back 50%, and then ran back up to double again, and then came back. And now it's up 50 some odd percent. And why that's important for people on here who are new investors or just curious investors, that's important because oil is a main component of basically every single product and commodity or product and service in the world. And so if the price of oil is up, that means the product of goods and services going up, whether it's because of the manufacturing process or the delivery process, the shipping process, whatever it is, everything goes up in price, which has the Fed on edge. So what you saw was the war starts, oil spikes, the Fed kind of not freaks out, but kind of hits the brakes a bit and says, well, wait a minute, this is going to mean inflation. But we know that the Fed can't control inflation on the cost of goods side because of energy spike. The cost of energy spiking, like that it has nothing to do with demand. It all has to do with, or even money supply. It just has to do with the pure cost of the main component of everything. And changing interest rates isn't going to do anything with that. What winds up happening is oil gets to a spot where it's so expensive and goods and services are so expensive that suddenly you have demand destruction instead of just pure inflation. I know you know this. I'm kind of walking through it for the benefit of the listeners. But so that kind of sets the frame of where we came into this week, where you had the Fed funds futures. They spiked. In other words, going into the Fed meeting a couple of weeks ago, the Fed funds rate was looking like it was going to come in by a full cut and some odd going into the end of the year. And then right after that meeting, and with escalation of the war and energy prices, suddenly you had the curve move up, the Fed funds futures move up, as you saw on Bloomberg yourself. And so now they've come back down, and it looks like the people are pricing. But what had happened is exactly what I said, is that people were expecting the Fed to put on, like, just stay on pause, not lower rates, and possibly feel like they had to raise them going into the end of the year. And then as we came into last week, investors realized, well, that's just going to cause this is just going to cause demand destruction. And so you got that turnover again. There you go. You can see it. And if you change that, the pricing date up there at the top, if you change that to, I think for one, maybe you'll somewhere in there, it'll show it. Maybe it's earlier than that, but it shows how the Fed funds futures, there it is right there, 325, how they actually were going up. And so now you get to today, they're back down because people are like, well, this is just going to, if anything, there's two things that are going to happen. You're either going to have demand destruction or you're going to have a resolution of the war. So that kind of just paints the whole picture coming into this week, where you had the president over the weekend or going into the weekend declaring, basically that Iran has, they have a finite period of time. I think he was giving them until Tuesday evening before he wiped them off the face of the earth. And now we have reportedly a ceasefire. There has been flare-ups, and it takes time for that message to get out to all the, all the sites. But in reality, a full ceasefire would probably look different. Where it's being negotiated apparently, and the real big crux is, what's going to happen with the Strait of Hormuz, and how is that going to affect energy shipping, oil shipping and energy costs going forward. But, back to first principles, I still believe that it's going to get resolved, and it's going to get resolved because there's a high amount of motivation of this administration not to have a long, drawn out, prolonged conflict out there, because everything you see would point back to when I was a child, which we had a similar situation where it was a conflict in the Middle East. Iran was a central player, and we had a spike in energy prices. We had to have rations for gasoline, where basically you couldn't, if you wanted to fill up your car, it depended on the license plate number. So if your license plate ended in an odd number, it was like you couldn't go get gas on an odd week of that month. And if it was on an even number, it was an even number. And so you couldn't get gas every week. And that was one thing. All prices spiked. You've seen the charts of inflation from when I was a kid. It was brutal. 70s and 80s, the prices of everything were just going straight up. I mean, mortgages were 18, 20%. It was insane. Now, if you go to today, you could have Volcker come in and raise rates during that time and just crimp down demand completely and lower prices. But if you tried to do that today, then you come up against a new problem. And the new problem is that our debt to GDP is no longer 30%. It's 130%. And so if you raise rates on the Treasury, I mean, that could end up being catastrophic for the Treasury, and just the sheer amount of debt they would have to pile on to manage all of that debt and all that interest, all the interest payments on that. So that's kind of just sets the stage of everything where we've been in over the last 4 to 6 weeks. It's been an interesting time, to say the least.
Fantastic. And that was a great explanation. It really is interesting, because the typical playbook to address this, which is using the interest rate mechanism, using policy rates in order to try to bring down inflation, it's not politically tenable. It's not economically tenable. We have, as you mentioned, 125, I think, percent debt to GDP right now. The debt maturity wall is just so huge, and more of that, particularly over the last 3-4 years, is purely interest payments. And raising rates in order to destroy demand, in order to crimp down inflation, it would make it's just economically unviable for the United States. Then the other side of the equation, we're sort of in an interesting spot. And Lynn Alden put this really well. I think she was on Danny's podcast, and she said that you can't print oil, right? So in a situation like this, where Iran, who's exporting 24% of the world's oil supply, is saying we're only going to let one tanker through every single day instead of the 130, 140 that they used to. All of a sudden, you've got a situation where we saw oil double in price. If this drags out, it could triple in price. We could see 120 again. We could see 150 again. And the issue for the Fed, where their solution du jour for everything is spin up a new acronym facility and print money out of thin air, can't really do that with energy. And so a swift resolution really needs to happen. Otherwise, you're going to be in a situation where you have an inflationary recession heading into midterms. And it just, none of it adds up.
Exactly. And that would be super damaging to the economy, obviously. And then the midterms, it would for this administration, they don't want that. And so they're doing everything they can. But it's a great point that Lynn makes, and I've heard her say it before, you can't print molecules, but they can print money. And they've been doing it, and they're going to continue to do it. It's just a question of how much and when. Yeah, and that's kind of where we sit now. And now looking at all of the markets, and of course they've rallied off of the news that we have some sort of agreement here. And obviously you've got analysts who are optimistic that that's exactly what's going to happen because of what you said. It's not just that we can't print oil. It's that you've got this economy that appears it could be rolling over itself with the massive layoffs that we're seeing in the tech sectors. Now, of course, it's difficult to tell exactly what the numbers are because the BLS says the way that they create the data for the job numbers, and I say create because it's not like they just survey and tell you what the survey is. They actually fill in holes. So if you've ever used something like Claude or ChatGPT, they love to fill in holes when you ask it a question and it doesn't really know the answer. It's kind of what the BLS does too. And they do it with their models and their assumptions, and they do it with something called the birth-death model, which it's problematic in so many ways. But basically, the birth-death model is not birth-death of citizens or people; it's births and deaths of companies, and the assumptions are wildly out of place every year. And so that's why you see like the revised jobs numbers down 1 million jobs after Biden left office, because they're like, well, we assume that there were more companies being created than actually were. So, oops. Are bad. And so, it's hard to tell exactly what numbers are, but I can tell you that young people are finding great difficulty finding jobs right now. Coming out of college, it's not easy to get a job. There's just not a lot of hiring going on. That coupled with a spike in oil prices, which means lower margins for all these companies, which means that they're just not going to be apt to hire a lot of people at this moment. That makes it definitely makes you wary as both an investor, but also like you said, with this administration and their policy, they've got to be sitting there thinking like, this can't drag on forever. We've got to find a quick resolution. Now, I can't get into their head again. I'm like, first of all, the geopolitics of this situation are far above my pay grade. I can sit here as an armchair quarterback and tell you what they should be doing, but I don't know all of the ins and outs of the players and exactly who's pulling what string. But you can just pull back and look at it and just know that there's little stomach to go forward with this for a very long time. And likely the success in Venezuela gave the administration maybe a little bit too much air cover and a little bit too much hubris that they could go in and affect the same kind of operation in.
So soon afterward too. It seemed like they seemed very eager getting over their skis, trying to do the same in and out, do it over a weekend, nothing comes of it. I think the key difference is that Israel and other nations have a vested interest in getting Iran off the map, or the current regime in Iran off the map, whereas with Venezuela, there aren't exactly a number of powerful nations surrounding Venezuela who are interested in getting Maduro out of there. And so two fundamentally different situations. Again, we can armchair quarterback all day long. It just seemed like the U.S. went over their skis with trying an operation that was so similar so soon after it.
Yeah, I agree. And so that's where we stand. And so for a little bit here, I mean, I've been watching the markets and just thinking, yeah, if you look at the S&P, it feels like it just wants to roll over. Of course, it did roll over, and then it looked like it was heading down more than just that 10 or 12%. But then you had the resolution here, and you can see on the, just where it is now, it just continues to rally back towards all-time highs. Part of that is that there's been a solid rotation of names. So it's not just those Mag 7 anymore. The Mag 7 are actually, before this, they were getting hammered before this. And so what was holding the market up was the rotation to other names, the other 493 names. And so part of that is what's going on. And that's kind of healthy, and that's not a bad thing. But then you look at things like gold and silver, and they ran so hard, so fast. They got a little bit of retail euphoria embedded in them over that period.
And this is the percentage change since the start of the war here. And you could see just the magnitude, silver and gold, both down, still trying to claw their way back up to their pre-war baseline. And the S&P in pink and the NASDAQ in yellow are just basically flat since the war started, since these developments you could see here.
Right, exactly. And so, and then is that Bitcoin at the top there?
That's right. Yeah, it's surprisingly resilient.
Well, and that's been a question I've gotten a lot of times from a bunch of different people, and the reason for that is that, I mean, quite honestly, Bitcoin was down over 50% from its highs before the war, and so it already drawn down significantly and severely. So having it go down further from there is almost like, I mean, Bitcoin's not telling the future, but happenstance, just a little bit of just timing there that Bitcoin had already drawn down. And so I still contend that Bitcoin's, it is drawn down to its low. If we get a resolution here, we don't get another, if we don't have a correlation to one event, then I think Bitcoin's already bottomed out for this period. But of course, that does depend on whether or not we have a severe escalation in this conflict, or if we have something else. If we have something, just entirely, which who knows? It seems like I've had a 100-year event, 5-6 times in my 25 career. So these 100-year events seem to come quite often. In high school, it was 1987, then it was 1998 with the long-term capital management. Then you had 1999, 2000 tech bubble. Then you had 2001, 9/11. Then you had 2008, great financial crisis. Then you had the 2020 lockdowns. So they just come often, and those are a correlation to one event where everything gets sold. And the reason for that isn't because, and this is what's important about looking at something like Bitcoin, for people to clearly understand, I'm extremely bullish on Bitcoin long term. And if we don't have another event, then I think we have bottomed. But the reason we wouldn't have bottomed if we do have a correlation to one event, and like you saw, gold drew down here. This is the important part of this chart, in my opinion, is that gold drew down here because of the need for cash. People saw this escalation, and they thought, if I'm going to have a margin call, I'm going to take some money off the table where I've had some huge wins, and I don't want to give those back. I want to take some off the table where and that's obviously gold and silver. And so they took some money off the table there to go into cash, both for just preservation of the capital of their portfolio, but also to have capital allocations ready, some cash ready in case they were getting margin calls on other positions. And so sometimes when you get into these situations of a correlation to one event, that wasn't what that was. It was kind of heading into it and thinking, oh, I've got to get ahead of this. But in those events, you walk into the trading floor off these hedge funds or these investment firms, and it's not like they pick and choose. They don't sit down and look at their portfolio and say, oh, well, let's maybe take off some Microsoft, and maybe, this one's had this up 3.5%. Let's look at, no, they walk in and they're like, take 10% off across the board, 20%. I would just liquidate. I don't care what it is. I don't care how much you love the position, 20% off the top of everything. We need to go cash on all of this and the reason for that is, I've explained this before in my newsletter, is that it's not like the day before a correlation to one event, you have a certain margin requirements, and they're called haircuts. And those haircuts are determined by your prime broker. So let's stay in the hedge fund world for a moment, because those are the ones who are moving around so quickly in this stuff. But in the hedge fund world, if you have what's called portfolio margining, like you could get Reg T in your portfolio in your personal account, and Reg T is just a New York Stock Exchange regulations. Reg T, where you can basically borrow for most names 50% of the capital. But in hedge funds, they can borrow up to like 94, 95, 96% of these names. And if they're treasuries, they can borrow even more. But for stocks, blue chip names, you could borrow 94% of these, and you could just have to have six. So it's called a 6% haircut, meaning you have to have 6% of capital in order to put up 6% of the capital for 100% of the position. But in a correlation to one event, overnight, those risk models change. And they change because of the volatility of the stocks, the implied volatility of the stocks. They change because of where the expected hedging is and options and all of that. And so the black box that they use, their risk desks use, it's not known to you. They use it, and then they tell their operations manager what that haircut is, and then they pass it on to their clients. And so it's like you're beholden to their risk models and whatever that is. Well, back in 2020, they changed overnight. It was like you went from 6% haircut to 25% haircut. And suddenly you're like, whoa, wait a minute. I've got a $10 million position in this blue chip name of Amazon or Apple. And before that $10 million, I only had to put up 6%. I only had to put up, $600,000. Now they're asking for me for $2.5 million. And now do that on every single position across the board. And some of the positions went from 50% haircut to 90% haircut. Meaning if you were only had to put up 50% of something, like they were like, no, you've got to put up, this is a micro cap. It's so illiquid. We're not even, we can barely give you any, maybe we won't give you any capital against it. And that happened so quickly that you're on that trading desk. You don't have time to react to that. You've got to get in there and get capital fast. And in order to do that, you're selling everything across the board. So that's kind of gives you an idea for the listeners why that happens in these drawdown days. Like you come in on a Monday and boom, everything is selling off. You're like, what is going on? Why is everything selling? Where's the safe haven? Well, there is no safe haven. The safe haven becomes your money market, and that's it. And that's the scary part. So in that event, Bitcoin won't be saved either. I mean, that'll draw down too. And I would expect that to draw down pretty steeply. If we draw down on 10, 20% on the market, Bitcoin will be down 10, 20% in a blink. And so that's unfortunate.
Yeah, for
reality.
reference, this is all the way back. The last 0-to-1 event, the last major one we had, March 13th, March 12th, 2020. You can see Bitcoin here, 50% in a single candle.
Boom. It was crazy. And I think it wouldn't be as extreme in this situation because we've already had a 50% drawdown. And we have a lot more players involved now with all the ETFs and the institutions around there and all the options that are built around this thing. I think that the volatility would be a lot lower on one steep drawdown. However, you just never know. A wick on Bitcoin of 10% is pretty much nothing. So all bets are off, but it would be momentary if it was that kind of candle. I don't expect that to last for days and days. That would be
speaking of institutional capital here, like the reason Bitcoin was able to draw down so swiftly by 50% and then take a very long time to recover, like number one, obviously because it hadn't drawn down by 50% at that point, but also because it was like a $300 billion asset, $250 billion asset, small in the grand scheme of things. And two, you didn't have the institutional capital that's layering bids all the way down. And if you look at the order book currently, like there is a huge buy wall at 60K, a huge buy wall at 50, at 55.
And those aren't showing all the orders yet. I mean, those are just orders that are sitting there waiting. Those are the stink bids that are waiting.
Exactly.
Just in case you're away from your desk, you don't want to miss it. But if it gets down there, a lot more bids will come in.
Oh yeah,
including from us.
100%. And I'll do my part with whatever they'll let me get on River or Robinhood that day, if it does happen. Speaking of institutional capital, other piece in the news you may have seen: Morgan Stanley launching their own spot Bitcoin ETF. A couple of key details. It's over 2 years since the launch of the other suite of ETFs that were initially slated, the BlackRocks, the Fidelities of the world, the VanEcks of the world. But not only that, they're undercutting BlackRock by 11 bips. So the management fee on an annual basis is only 14 basis points, cheapest spot Bitcoin ETF on the market. And obviously, they're one of the big four wirehouses in the United States, which is pretty significant. It seems pretty significant. They're distributing their marketing collateral now. It just went live yesterday. What's your take on this? Do you think it's going to be something that draws in capital from other ETFs and isn't really a net addition for Bitcoin AUM as a whole? Or do you think this is something different entirely?
So that one, yeah, I mean, what's important for that is if it signals that they're ready to really make a push for their own clients, right? So they don't want their clients to move away from their products. And in my mind, that's a significant development of that specific security. Because if you think about it, if you're Fidelity, you're not going to be putting your investors into IBIT.
Mhm.
You're going to be giving them the best rates, the best haircuts on IBIT. You're going to want to keep them in house. Obviously, you get to clear it, you get to hold it, settlement. You're the custodian of it, and so that's likely what's happening there. Is that they're opening the door to allow for that push from not just high net worth investors, but kind of across the board.
Right. That makes sense. And it's pretty significant too. I believe they have in their investment management division, I think they have closing in on $7 trillion in AUM. They have 16,000 global advisors, which is quite crazy. And so you've now got 16,000 advisors globally who are actively pounding the pavement, selling this thing to their $7 trillion in AUM. And this is the same institution. I wouldn't be surprised
if it became something where they said you should have a 1-2-3% allocation to Bitcoin alongside your other, and just have it as like a portfolio staple.
Yeah. Morgan Stanley, I think,
started hearing that.
Yeah, I think they recommend 1%,
Right.
1 to 2%. I think B of A recommends 2%, normally 4% for higher risk portfolios. So this is happening, and it's really interesting to see that they came into the space so late in the game. Perhaps it was just seeing how well BlackRock's ETF did for them, saying they wanted a piece of the pie. They don't want their clients to jump ship. But for me, it's interesting. I haven't quite been able to put my finger on why they were sort of so late to the game and why they're launching now of all times with Bitcoin trading at a 50% discount. You would think something like this may launch during a rip-roaring bull market rather than 5 or 6 months into a bear market.
Well, they take forever to do these things, right? So to get them internally set up, they get all of the parameters around it, and just your legal and compliance to sign off on it to determine exactly how it would be marketed internally and externally, all that, and then the regulations around it and the filings and all. It just takes forever. So this was well underway, I'm sure, long before we had that October drawdown. Right. So, but then there's the new Bitcoin ETF that has the options involved, right? So, which one? What is that called? It's a new one with dividends, and it's a covered call
Bitcoin
strategy.
Premium Income ETF, BITA by iShares.
That's it. Yeah. So, and that's interesting. So just a way that they're going to then sell the volatility to give people yield off of that. So, and that's another interesting point. But you're going to see them. You see a lot of ETFs built around Bitcoin over the next number of years, and it just makes sense because you not only do you have MicroStrategy offering yield bearing instruments in their preferreds or perpetual preferreds, along with what we're doing at Strive, the same exact thing in a smaller manner and a little bit higher dividend. You're going to see demand for things like this, and it's just going to continue to pick up, especially as your investors get more and more and more comfort and understanding around Bitcoin itself, which has been the biggest hurdle for Bitcoin, is that, yeah, it's getting adopted by Wall Street, but by and large, your typical retail investor does not understand it yet. Now, remember, Wall Street's investing a lot of things that your typical retail investor doesn't understand. So that's not a red flag. That Bitcoin is complicated. The underlying premise is complicated. The reason to buy it is simple for you and me, because we've been studying it and looking at it for years and years now. For a new investor to explain to them why it's hard money, man, it's a tall hurdle to get over, as you well know. But now you've got Wall Street coming in and offering all of these products to each other. So now you've got these yield products that are out there for not just individuals, but also for institutions that want to layer some of this stuff in, for hedge funds or family offices, or smaller endowments and or pension funds. And so, but it's not new. I mean, Wall Street's come up with all kinds of things to invest in and trade that you would never touch as an individual investor. And because it may not be available to you, or you just don't understand it well enough. But I think it's encouraging to keep seeing more and more things being built around it. Now, the flip side of that, which we hear all the time too, which is paper Bitcoin holding down the price. Oh my God, Wall Street's ruining it. And I just couldn't disagree more. All these ETFs have to hold Bitcoin. BlackRock doesn't own, they don't own hundreds of thousands of Bitcoin. Their investors do. Their underlying portfolios that are managed for investors do. So it's not, or it's all the investors around the street, individual investors who own IBIT from other firms, whether they own it through Schwab or Robinhood or wherever. So it's not true that BlackRock has seized control of Bitcoin and that, now they've ruined it. It's never going to go up again. It's just not true. So I think that's just more fear out there. And quite honestly, Wall Street was always going to be there at some point. Now they're here. And it's the question of, where do we go from here, and how quickly does it become, like we just said, a separate allocation in most portfolios, much like gold would be? How quickly does that happen? And when it does happen, does it take off like wildfire across the street, or does it kind of trickle in from here to there? And I kind of think it's just going to trickle in as more and more investors get more comfort with it. And that comfort only comes with understanding, which goes back to the first statement of, it's a difficult concept. The protocol is difficult to understand, why it really is decentralized, how that makes it immutable and all of that. It's not it's not a short putt now that we're in Masters Week, so we might as well use our golfing terms. But I do think that BlackRock is still on the fairway here. I don't think they're not off in the rough. They're not in the.
Look at you go. 2 golf analogies in one. I love it. That's great. Well, speaking of difficulty understanding, well, for one, I think that the paper Bitcoin stuff, it's sort of understandable. It's like an immune response after like 5, 10, 20 years of scams from overseas. And basically every cycle, new bucket shops, turns out they don't actually have the assets to match their liabilities and they go under. But it's a different game with Wall Street. Like, the amount of auditing that these people have to go through is completely insane. But speaking of not understanding things, there's a lot of quantum FUD around Bitcoin. The phrase that I generally ascribe to is preparation, precaution, over panic, right? To say that this is an imminent threat that's going to destroy Bitcoin in the next 6 to 12 months, it's kind of unfounded. If that were the case, I think you'd see Bitcoin trading at a much steeper discount than it is right now. But certainly quantum computing, particularly the latest research papers about hypothetical capabilities coming out of Google, they warrant some concern. They warrant some activity from developers, and we are seeing it as well. We're seeing many different proposals come out. So how do you think about quantum computing? Obviously, working at the Bitcoin Opportunity Fund, how are you guys understanding the current state of quantum, and how should investors be thinking about this?
No, I think it's the exact same thing. Of course, when you see the headlines, you see the white papers come out from Google, you immediately think, oh, like, is this an attack vector? Is this a failure point that we're overlooking as a whole? Well, like you said, the good news is that immediately it gets picked up. Immediately everybody starts talking about it. Immediately core developers start talking about it. And they're like, no, no, we're working on these things. It's not like we're just sitting here idle waiting for quantum computing so we can then maybe come up with a solution. They're actively working on it. Any quantum development and any inroads that are made there, they're going to be, Bitcoin is going to be making the same kind of developments and progress in parallel. It's not like it's just going to happen in a vacuum. And so it does take investment and money. It does take support from the Bitcoin community to do that. It's not like this, again, that also doesn't just happen in a vacuum. But if you believe that Michael Saylor, for instance, and MicroStrategy and a lot of these treasury companies are going to be sitting here idle watching this happen without giving any support or insight and to developers, core developers, or OGs who are sitting on hundreds of millions of dollars worth of Bitcoin, that they're not going to give any support. Of course they are. And so I don't believe that happens in an attack vector from the side that Bitcoin is caught flat foot on. So now maybe that's a little bit optimistic, but the reality of what you just said is it immediately has everybody on guard. And so being overreactive can be a positive thing in this situation where you're overreactive. So, okay, so what do we need to do? How do we need to approach this? And what are the failure points? And really, how much time do we have? How far behind are we? And so, no, the way we think about it is the same as you. Is quite honestly, I'm a lot more worried about what tweet comes out next, as far as the short-term pricing aspects of Bitcoin. As far as failure points, I don't see it as a failure point, at least not yet.
Yes, certainly. I tend to agree with you. And there are plenty of positive developments. I mean, I'm seeing at least one or two a week new headlines about different methods of securing Bitcoin to be post-quantum ready, if you will. Yeah, so it's not, and also like you would just see it in the price. If the reason for Bitcoin's decline was quantum, it would be inversely correlated to quantum stocks, but quantum sold off with software, we're sold off with Bitcoin. So, it's not reflected in price yet, but the overreaction is good because it's better to have a solution and not need it than need a solution and not have it. I want to jump back to Bitcoin's current performance, but more so some news that we got yesterday out of Iran concerning the Strait of Hormuz. We only have one source on this so far, it's the Financial Times. The story is that they're going to be accepting tankers to come through the strait with a caveat. So with a tariff, with a $1 tariff per barrel for every single barrel. And it must be paid in either Bitcoin, and the latest update is either Bitcoin or Chinese yuan. So a lot of folks ran the numbers on this. And again, this isn't confirmed. They could just be trolling Donald Trump for all we know. But some of the numbers on this are pretty staggering. So if you take a look at the amount of loaded ships that cross the strait per day pre-war, it's about 130 to 140. At current prices, that's roughly, and the amount of tankers, the amount of barrels that these tankers carry, about 2 million barrels, that would be roughly 3560 BTC per day. The entire Bitcoin network mines 450 Bitcoin per day. And so it's crazy math. And if you extrapolate that out even further, so it's 8 times the daily issuance rate. But it would only take, if this occurred and it happened for 8 straight months, then Iran would have more Bitcoin than Strategy over an 8-month period. So pretty wild news. It didn't really have a major impact on Bitcoin's price because it does seem like the market is considering this hearsay. But either way, let's do a thought experiment here. If this doesn't wind up being hearsay, if this winds up being put in place, what sort of a development do you think this is for Bitcoin? Finally being used as a global medium of exchange, as money for enemies. And if Iran does follow through with this, what do you think not to be armchair quarterbacks here to tie it all back in, but what do you think the response from the United States would be?
Yeah, that's a good question. And really the most important, if that really is true, the most important piece of that is the negative impact of the U.S. Treasury, right? So we've been talking about how stable coins are so important going forward because it allows for a transaction on blockchain to filter through for the purchase of U.S. Treasuries. Basically, if you have a stable coin, for those people listening who don't know what that means, it means that a stable coin would be pegged to the U.S. dollar, a U.S. stable coin. Most stable coins are U.S. dollar stable coins, but it could be pegged to anything. But USDT, USDC, our Tether and Circle are both pegged to U.S. dollar. And if you're going to be pegged to the U.S. dollar, then as the stablecoin issuer, then when you take money to create stable coins, then you've got to make sure that that money is stable to the dollar. How do you do that? Well, you have it in dollar denominated assets that aren't very volatile. What's not volatile in a dollar denominated asset? UST bills. And so you're able to go, you're buying T-bills, and maybe a mix of treasuries that are longer dated if you have enough money and enough of a balance sheet that you can manage that. But basically that's what it is. You're buying U.S. treasuries. And so, okay, that's great. So that would be the inroad to getting more and more customers of U.S. treasuries. That's the theory. But now you've got something where you've got the BRICS nations, supposedly, China being the central player there, who have been talking about getting outside the U.S. dollar system because they don't want to hold treasuries because they know that the underlying currency that they're based on is being devalued every day from inflation and expansion of the money supply. They know this. Everybody knows this. And so they don't want to hold these things. Also because they don't, there's a couple of reasons, but another reason is that we made a geopolitically catastrophic mistake when we seized the Russian assets and froze their treasuries, and froze them out of the SWIFT network. And they're like, well, obviously we don't want to use US dollars anymore, US treasuries anymore. And it gave the signal to everybody around the world that if you're not perfectly aligned with the US, that we may just seize your treasuries or cut you off of the US dollar system. Well, it's kind of a stupid thing to do when you need everybody to buy your treasuries. So that was, in my opinion, that was a critical mistake. And so now we're seeing something like this is a perfect example of an offshoot of that mistake. That the result of it is you've got players who are looking to get outside the dollar system. Now you look at Bitcoin. Okay, let's say that it does happen and they will accept Bitcoin. Forget about the yuan. And you're talking about hundreds of thousands of Bitcoin that would be purchased. And so, yeah, the price of Bitcoin must go up. Well, in reality, who's getting those Bitcoin? If it's Iran, if it's in some sort of energy sector in Iran, depending on who gets it and how it's distributed, are they going to hold on to Bitcoin or are they going to turn around and sell it? So I'm not sure that it would be as big of a price development as it would be, but I do think that it would be a huge development for the ecosystem and just for the growth of the ecosystem, that now you've got oil being traded, and a tax on that, a tariff on that would be denominated in Bitcoin. That would be a very big deal. But as far as it impacting price, it's hard to tell because it might spike it short term, but then as those Bitcoin are used and they're distributed, they're likely sold for whatever underlying currency that receiver would want. And so if it's Iran, the Iranian government, then will they sit on the Bitcoin? Maybe, but I would say it's more likely they turn around and buy gold with it. But at this point, I wouldn't advise them that. I would advise that they sit on it, but but I'm not into advising Iran anyways. But so that's kind of if it were me, I would hold it, but I doubt that would be their play. That's just that's just the reality of it.
Yeah, it certainly seems so. I think potentially you could see near-term price spike, but almost all of it would be converted into the their currency of choice. One other neat thing too is that if they do decide to use Bitcoin as payment rails, they could, now that we have Taproot, we have Taro assets, they could pay in US dollars, but over Lightning, or they could pay in whatever currency you want, but over Lightning. So it's going to be interesting to see how it unfolds, if it unfolds, or if we don't see any peace talks at all because Iran is sanctioned and the U.S. doesn't like the fact that they're trying to charge tariffs, and then we go in and actually do wind up putting boots in the ground, which would certainly not be ideal. But either way, it remains to be seen. I'll have to get this podcast out quickly because who knows what will develop overnight and what Trump will say on Twitter.
By the time we're done with it, we got to check the headlines.
Seriously. I want to ask you before we wrap here about Kevin Warsh. So, new Fed chair, first new Fed chair in about a decade, which is interesting. We've had Powell for a decade. How do you think Warsh will differ from Powell, if at all? Or do you think the math behind the situation at the U.S. Treasury is just so astronomically difficult to surmount that really there's not much different you can, or there aren't many ways you can differ from Powell in terms of the way you conduct monetary policy? How do you think it's going to shake out?
Yeah, I mean, Warsh is, he's famous for being a dissenter, back when he was on the Fed. He was a young guy at the time, but so people think he's going to be more hawkish. But the reality is, just contrasting with Powell. Well, Powell's been there for a while, and famously now is he's got an antagonist in Trump. I mean, Trump just belittles him at every corner. He too late Powell is, I think, what he has labeled him. And so, and he goes in and he's angry that he hasn't been lowering rates. The back story there is that going into the election, Powell lowered rates by 50 basis points going into the election, declaring they've conquered inflation, the economy is rolling on, and it's time to lower rates. And now we're at a great place to start, bringing rates down and getting the economy and being less restrictive. And then the election happens. Bitcoin runs. That has nothing to do with the Fed decision, I don't think, but they turn around and they're just like, okay, we're going to hold off on raising and on lowering rates anymore. Well, the problem with that is that you had a Treasury Secretary coming in who was highly critical of the last secretary. So you had before you had Scott Bessent, who came in as a successor to Janet Yellen. He was highly critical about the fact that Janet didn't term out the debt because she had a chance to issue longer dated securities in order to bring down the cost of refinancing all this debt and the cost of the interest payments on it. But she didn't do it. And so here, they come into the election, they think, well, they're going to be lowering rates now. And so we're in a good spot. We're going to be able to term out the debt maybe a little bit in a year or two. Well, it doesn't look like that's going to happen now. Now, the Fed is held strong. They refuse to lower rates. So now Bessent's been caught flat-footed. He's like, great. Now I'm stuck with all this debt that I have to roll over. Congress isn't lowering the spending. They tried to lower the deficit with the Doge Commission. It did basically nothing. Deficits are still growing, and that has to do with just a structural problem with them and our policies. But regardless, now you've got Warsh, who's been nominated by Trump. Well, before that, you actually had Trump bring Powell into the facility that they're building, the new facility for the Fed, this new set of buildings. And they're standing there. When you saw this, I'm sure, Joe, they're standing there with their hard hats on. And I mean, Powell looks like a little boy next to Trump. Trump's a big guy. He's got a big hard hat on. He's standing there big and strong. And Powell's standing there in a suit and he's just looking down and looking almost, he just, believe me, Trump, I believe, orchestrated this purposefully to make him look little. And so he pulls out the piece of paper like he's the teacher who's admonishing the student and says, you're over budget. And, and then he slaps him on the back. And you could just see Powell's like, God, this guy, I do not like this person. You can just feel it. And so every single press conference that Powell has, he's likely biting his tongue, and he talks about tariffs, he talks about inflation risks, but he clearly is not apt to do what Trump wants him to do. And so now you've got him saying, well, I'll stay as long as I need to. And then that's what he said in the last press conference. You're like, well, what does that mean? Well, Warsh has not been confirmed yet. And who knows what Congress is going to do and whether he gets his confirmation. They could hold it up. They could refuse it. Who knows? And I happen to think that he will get confirmed, but who knows? And so, but let's say that he does. Let's say he gets confirmed. Powell, his term ends, and now you've got Warsh who comes in. Does that mean we're going to immediately see an easing of Fed policy? No, I don't think so. I think that would be damaging to the Fed and Warsh's credibility, because then it would be clearly political that Powell gets he now his term is over, and he steps down, and this new Fed chairman comes in and immediately starts lowering rates. Well, what does that say? It either says that Powell was wrong and they should have been lowering rates all along, or it says that Warsh is doing Trump's bidding. So either way, unless we have some serious economic downturn data here, meaning the unemployment rate starts to spike up and really triggers a Somme rule, or you've got some sort of inflation spike that is structural. It's not just this one-time thing, but it's a structural inflation spike that has to do with demand, and you've got a productivity spike in GDP that's causing all this. Possible, I don't see it, but possible. Unless you see the rates really come down. I'm sorry, the prices really come down. Sorry, I'm talking around in a circle on inflation, which people are worried about the inflation spiking. But if you saw prices really start to come down because oil gets cut in half, demand gets cut in half, you see layoffs, it starts to spool into the economy, and it happens all very quickly over the next 6 to 8 weeks. Warsh doesn't really have the cover to start lowering rates immediately. So that's a long way of saying that I don't think much changes immediately. It will take a while, and it will really depend on the data that we see and what happens with this war, what happens with oil prices, what happens with the economy. If we start seeing acceleration of layoffs because of AI, for instance, and there's not hiring around it in different areas, then we could see a problem in the economy, and we'll see that data. But I don't think it's going to happen in the next 6 to 8 weeks. It's going to take a while. So, but I guess we'll see. But that's kind of the way I see it, and the way I'm looking at the Warsh appointment. I don't see it as a risk either way, and I don't see it as a great relief coming down the pipe. Could the forwards reprice? Sure, that would make sense if you saw the Fed funds rates, the futures come down over the next year. But I don't think that you're going to see the 2-year suddenly drop 25, 50 basis points just because Warsh has been confirmed in. That doesn't make sense to me.
Absolutely, yeah. Path of least resistance, the likely path, business as usual for the time being, unless we see, number one, either extreme inflation as a result of the continued war in Iran, which leads to demand destruction, which leads to the Fed having to step in and print massive amounts of money, or you see AI-related tech layoffs, if that's the direction we wind up going. Because I have seen others argue that the productivity gains is going to lead to even more hiring. So we'll see what that certainly could.
Right, exactly. But
exactly, so.
and then, but if you do see demand destruction, or if you see a downturn in the economy, either way, the Fed's going to have to print. There's just no way around it. So you're either going to get an economy that's roaring or an economy that's turning over because of either the layoffs and inflation or demand destruction. Either way, the Fed's going to have to print. There's just so you're going to have a rise in asset prices because of the economy roaring forward, or you're going to have you could have a drawdown and then a rise in, like we saw in 2020. In asset prices because of the need for additional liquidity. Either way. So, the question is, what happens to the 10-year, 20-year, and 30-year? And as we're going through to refinance this debt and the wall of debt that you spoke of at the beginning here, what happens then? And do we see an operation twist yield curve control where the Fed comes in and starts printing money and buying the longer dated bonds in order to keep those rates lower? Because nobody wants mortgages to be 8, 10, 12, 15%. I can't see that today, but nobody wants them at 7, 8, 9%. Let's put it that way.
Yeah, it's really interesting with the housing market. I think homes are beginning to sell at the margin, but the 30-year is just having a really difficult time coming down. The 30-year fixed, really difficult time coming down. So yeah, so many things coming to a head. It'll be interesting to see. We'll have to have you back on the show sometime soon for a follow-up, maybe next quarter. James, thanks a lot for coming on, man. I appreciate it. I'll let you get back to watching the Masters here in a moment. But before we sign off, where can people find you?
Yeah, thank you, Joe. It's always good to be here. You always ask good questions. So everybody knows that I co-manage the Bitcoin Opportunity Fund, or if you don't know that, then, and if you're a high net worth or an accredited investor and you're interested in investing in the Bitcoin space, then you can get a hold of us at bitcoinopportunity.fund. That's and we can sit down and have a conversation with you or get online and talk to you, see if it's something that would be appropriate for you and your portfolio. And then, of course, I write the informationist newsletter on Substack, and you can find that at jameslavish.com. It's a newsletter I write every single week, and I simplify all these topics and get you ready to make the decisions for your own portfolios every single week. So lots happening, and it's never boring. We always have good topics. So.
Absolutely. It's one of the best newsletters out there. Highly recommend it. The link is going to be in the show notes to check out the Bitcoin Opportunity Fund, James's X, and also sign up for the Informationist. James, thanks again for coming on. Appreciate it.
Thank you, Joe. See you next time.
And then there's one which does nothing, Bitcoin or something like that.
Bitcoin's 17 years old. 15 years is a $2 trillion asset. And
I could care less what Bitcoin trades for.
it's just a matter